Welcome. Welcome to our October Tools for the Creative Life. Keeping your books clean when your art is messy, all about tax and accounting basics for artists. We're going to hold here for maybe a minute. We had quite a few people sign up for today, and we're just going to give them a chance to log in. So for those of you that are already in, thank you for joining us. Please keep yourself muted, but feel free to say hello in the chat. And we'll hold for just a bit to make sure everyone has a chance to get in. So yeah, feel free to say hello in the chat. Feel free to introduce yourself. Let us know what kind of art or creative endeavors you pursue. That will absolutely help our speaker today to tailor her remarks. All right, I'm gonna go ahead and get us started. Take our little welcome screen down. So thank you all for joining us. I know there's more that will be hopping on for this Tools for the Creative Life workshop. This is part of a monthly series that several organizations here in the Denver metro area put together for artists and creatives. Today's workshop is all about taxes and accounting basics for artists. Before I go into some of my housekeeping items, we always begin these sessions with a land acknowledgement. So I would like to, even though we are in a virtual space, I would like to acknowledge that the land that we live, work, and create on is the traditional territory of the Ute, Cheyenne, and Arapaho peoples. We intentionally recognize the 48 contemporary tribal nations that are historically tied to the lands of Colorado and make up this land, historically tied to this land and make up what is now Colorado. We honor those elders past, present, and future, and all who have stewarded this land throughout generations. We recognize that government, academic, and cultural institutions were founded upon and continue to enact exclusions and erasures of Indigenous peoples. We commit to cultural equity and strive to make this a safe and welcoming space where healing can occur, truths can be told, hidden stories unearthed, and legacies of oppression and inequity continually dismantled. In addition, we are dedicated to presenting this webinar in an inclusive fashion. So we encourage you to update your name to include your pronouns if you'd like. So for those that are on Zoom, we invite you to rename yourself and add your pronouns to your title. A few other webinar housekeeping items. We ask all of our participants to please stay muted. That just helps avoid any background noise. You are welcome to keep your camera on or off, whatever helps you stay focused and participate today. We do encourage you to use the chat. I know several people have already introduced themselves. We welcome that. That is also where we'll be collecting questions. So if you have questions throughout the presentation, no need to wait until the end. Please put them into the chat as they're top of mind. I'll be keeping an eye on that, monitoring it as we go. And we'll be able to ask those either in the middle of the presentation or more likely save them for the end. But we want to make sure you can share those questions and thoughts as you have them. We also offer closed captioning. So for those with us live on Zoom, you should have the option to see captions or subtitles. You can turn that on or off. That's what it means when it says live streaming. We are live streaming to an AI computer that is creating those captions. We are recording today's webinar as well. We'll be sharing that link via email to all of the registrants. We'll be sharing it on CBCA, our organization's resource page, and making that available. So if you want to rewatch any of this content, if you want to share it with someone, we are excited to make that available. I think I was remiss in introducing myself at the beginning. I'm Meredith Badler. I'm the Deputy Director at CBCA, Colorado Business Committee for the Arts. We are honored to be one of several programming partners that puts together the Tools for the Creative Life workshop series, all about providing resources, connections, networking, opportunities for learning for our arts and creative sector, primarily in the Denver metro area. I'd like to acknowledge our other partners and invite them to say hello in the chat. Feel free to add any links or updates. Tools for the Creative Life is produced by Denver Public Library, the RiNo Art District, Transforming Creatives, which also has a space called Converge Denver, where we often host many of these workshops, and the Creative Integration Initiative. And CBCA and us. So I'll also throw some things in the chat. With that, team partners, did I miss anything? I see thumbs up from John and from Teague. Thank you. It is my real pleasure to introduce our speaker today, Kaleigh Canavan with CSA Accounting. She is an accountant. She's a CPA. She helps a lot of creatives and small businesses with their taxes and accounting needs. She also has a wonderful background in the music industry, which is where she was before starting her accounting practice. So we are thrilled, as always, to work with individuals who deeply know and understand and appreciate our arts and creative sector. Kaleigh has a lot of great information to share with us. Again, we'll be recording this. Put your questions in the chat. We want to make sure this is as helpful for you as possible. So with that, Kaleigh, I'll let you get your slides up and take it away. That looks great, Kaleigh. Does that work for you?
Yes, and am I unmuted?
Perfect.
Okay, great. Hi, everybody. Thanks for coming. Very excited to be here. Meredith did a great job introducing me, so I'm not going to go into that too much, but Kaleigh Canavan, I own an accounting firm that is entering its 10th year in business. And before that, I was part of the music scene in Denver, working for one of the bigger promoters. So I know several of you here already. Nice to see you. And for those that I don't, nice to meet you. Big thanks to all of our sponsors and producers for having me here. And let's get into it. I'll try not to make it too boring, but the material is dry. So we're going to talk about a lot of different things today. The main points that I wanted to touch on, but of course you can ask any questions that you want in the chat. We're going to talk about estimated payments, whether or not you should be making estimated payments, when, how much. We're also going to talk about self-employment taxes, because in the eyes of the IRS and most states, if you're an artist, you are likely self-employed. So that's an important thing to understand. Going to talk about income and expenses, what you should report, when to report it, what you might be missing as far as what you can deduct, and also make sure to report all of your income and why. And then finally, I'm going to touch just for a minute on grants, because that seems to be a hot question for a lot of artists. There's been a lot of really cool grants out there recently, and we want to make sure that you are compliant in the accounting requirements of those funds. So did want to say real quick that my brain doesn't really differentiate between your art and business. So when I say your business, I mean your art. And when I say your art, I mean your business. Just don't want to have any confusion there. Your art is business for the purposes of this conversation. Quick disclaimer, today's presentation is meant to provide information as general concepts related to tax and accounting, but I cannot give you specific advice unless and until you are my client. So hopefully this gives you some thoughts and ideas of conversations that you should take back to your accountant, or I always welcome new clients if that's something that you want to explore, but I can't give you specific advice on this webinar, and you should not construe it as such. Similarly, I am not an attorney and I am not a graphic designer, so I did the best I could with this presentation, and I appreciate Canva, honestly. That said, let's get into it. Estimated payments. Should you make estimated payments? When and how much? Estimated payments are frequently called quarterlies because in theory, you should be making them 4 times a year. The guidance on that is if you intend or anticipate that you will owe more than $1,000 in tax when you go to file your taxes in the spring, then you should probably consider making estimated payments. Estimated payments are basically in anticipation of the tax that you will owe, because the IRS and the states prefer to receive their money periodically throughout the year as opposed to one big lump sum at the end. So even if you file in April and you pay 100% of what you owed, you could still be subject to penalties and interest because you did not make periodic payments throughout the year. That said, all we can do is our best, right? Especially in an industry such as art, where it's kind of feast or famine. So the schedule for making estimated payments quarterly is April 15th, June 15th, September 15th, and January 15th. And one of the things I encourage you to do when you're thinking about that is at least look back at the year that you've had so far and recalculate those estimates every time, because if you've had a really big quarter, you may want to make a bigger payment than the prior estimate was, or on the flip side, if it's been a pretty low quarter, then maybe you can pay a little bit less. If you sell in several different states, you should also look at whether or not those states have filing requirements for estimated payments, because typically the revenue that you generate is going to be based on the state where that revenue came from. That gets really cumbersome when it comes to performing artists who maybe tour. If that is you, please don't go it alone. Don't try to do that yourself. But just keep in mind that if you earned money in several different states, you probably have a filing requirement outside of just your home state. So how much should you pay in estimated payments? There's a few factors that you should consider. Look at all of your income, because many artists have a day job or a side gig or something along those lines where you're receiving a W-2, which means that your employer is paying in taxes for you in the form of withholding. That means that the estimated payments that you're required to make could be lower because you're already being paid in throughout the year with your paycheck. So you'll want to factor that in as well. Forecast as much of your annual income as you can. If you think you're going to earn $50,000 for the year, even if you don't have that cash in hand, you'll want to factor that into how much you're making your estimated payments for, even though it's really hard. But the main goal in making estimated payments is to avoid penalties. A lot of people think that if you make estimated payments, then you should either be owed a huge refund at the end of the year, or at least not owe anything. But really what you're trying to do is just make it so that the tax that you have paid in is sufficient to avoid any penalties and interest that the IRS or the various states might tack on to that. In order to safeguard yourself from penalties entirely, you'll want to pay 110% of your prior year's tax in the form of periodic estimates. And pro tip, you can find last year's tax on line 16 of your personal 1040, and then just calculate 110% of that. Don't worry, I also use a calculator. Self-employment tax. What is it? Why do we pay it? In the eyes of the IRS, you are self-employed when you're an artist, basically meaning you're not getting a W-2 from an employer, but you're earning income that is taxable, and therefore you're going to pay self-employment tax. And the reason that we like self-employment tax, even though it doesn't feel good when you're paying it, is because that is the means by which you pay into Social Security and Medicare. Those are both funds that if you ever intend to withdraw anything from them, you need to pay into them beforehand. So we pay self-employment tax so that someday we can collect Social Security. Otherwise, you're not paying that in, because when you have a normal job, you're paying in through your withholding, and your employer is also matching you at about 7.5%, which brings us to the 15.3% that self-employment tax usually is. This is a factor in your estimated payments, so you'll want to make sure that you're considering that. And not all entity types are subject to self-employment tax. So if you are running your art through your Social Security number, if you're a sole proprietor, if you're part of a partnership, chances are you're going to be subject to self-employment tax. The only times you would really see not being subject to self-employment tax is if you have an S Corp or a C Corp. I really hope none of you have a C Corp. That's just my side comment there. So when to become an S Corp is a really hot button question for a lot of people. S Corps are not subject to self-employment tax, so a lot of people think that it's the way to go right away. However, S Corps are, they have a lot of administrative burdens that you want to make sure make sense for you and your art and your business. So an S Corp needs to file its own tax return. An S Corp has to run payroll for the owners. You have to pay yourself reasonable compensation. And these are all conversations that you should have with your accountant to make sure that the benefits of not paying self-employment tax are outweighed by the administrative burdens. Typically, I don't recommend an S Corp unless and until you're kind of kissing that 6 figures in revenue mark, because at that point, the tax savings is getting significant enough that it makes sense to have to jump through all of the other hoops and hurdles that come with the S Corp status. How much should you save for taxes if you're self-employed? There's a terrible joke out there that if you ask an accountant what 2 + 2 is, the answer is it depends. But typically, I tell my self-employed clients that we want to see you saving between 25 and 35% of your earnings. And that is because when I calculate the tax that you owe come April, I would rather you say, oh, bummer, but at least I have it, as opposed to us having to scrape together the funds for you to pay your tax along the way. The IRS does take payments if you didn't set aside enough, and most states do as well. However, there's almost no one worse that you can borrow money from, because they are going to tack on penalties and interest for every single month that you owe a balance. So even if you're on an installment agreement with the IRS, it can end up being pretty expensive, whereas just setting this money aside as you earn it, it's a bummer to see it just sitting there in your savings account, but it's a better position overall. And tax planning can also help with that. If you get with an accountant around this time of year, sometimes we can look at different strategies that you can employ to get your taxable income down so that you ultimately end up falling in an effective rate that's closer to the teens as opposed to that 25 to 35%. Income and expenses. What should you track, when, and how? Wanted to touch on the why also here. So a lot of times people think money under the table is not reportable and we just won't even include it in the tax return. And there's a couple of reasons that you shouldn't do that. One is that it's not compliant with IRS regulations. You have to report all of your income. But the other is that sometimes you are shooting yourself in the foot in your big picture goals when you're not reporting all of your income, because you need to have that income on paper to apply for a mortgage or a bank loan. When COVID happened and all the SBA programs were coming out, there was a lot of people who didn't qualify for certain PPP funds or EIDLs because the income that they had reported on their tax return didn't quite capture the whole picture of the income that they were losing when all the shutdowns happened. Whereas if you report all your income, then you can factor those things into those programs when you're applying for them. So make sure that you're reporting all your income for one reason or another, whatever your priorities are. Different types of income for artists. This is not an all-inclusive list, but I did put it together so that hopefully it'll make you spark some ideas about different revenue streams that you have. Sales is the easy one. That's you literally selling your art, sculptures, paintings, maybe it's music. Collaboration. If you were brought in by a different artist to help produce an album or produce a piece of art, then the money that they pay you to help with that is also a revenue stream for your artistic business. Grants are awesome. Sometimes they're taxable and sometimes they are not. So you'll want to, I'll dive into that a little bit later, but typically they are referred to as reportable, but not taxable. You'll want to factor that into your total income because the IRS wants to know that it happened, but that doesn't mean that it's going to generate tax burden necessarily, as long as you've used those funds in the ways that the grant intended. And then other stuff along the way is if you teach or have one-off gigs, commissions, pop-up events, royalties, all of those things go into the big ball of wax that is your art business. Expenses. What's deductible, what's not? There's some really obvious ones like your supplies, be that office supplies or art supplies. Those are pretty much always going to be deductible. Guitar strings, if you're a musician, those types of things that you absolutely need to have in order to produce your art. Your materials is more customarily considered the actual things that go into what you're producing 100%. So that's your canvases, your clay, those sort of things that you need to replenish with each thing that you produce. Education can sometimes be a business expense, only if you're using that education to further your skills in your existing trade or business. So if you're a graphic designer and you take some classes on Procreate or something along those lines, that's going to be deductible to the business. If you're taking classes so that you can shoot off a new revenue segment of your business, that's likely not deductible to the business itself, but you may be eligible for other education credits such as lifetime learning credit or the American Opportunity Credit. You'll want to check with your accountant on that. And then another big one that people miss along the way is assets, which is your big spends that help you to make the things that you do. So that's your computers, if you've purchased machinery, any sort of equipment that you spent a lot of money on and you're probably going to use it for several years, that's going to be deductible to you and the business as well. Other expenses that are less obvious are anything can be deductible. Let's put it that way. But it depends on certain factors. And the IRS wants to meet these three criteria when it comes to things that can be deducted by your business. Are they reasonable, ordinary, and necessary? So reasonable means, can your business afford it? Can you explain how it's going to help you generate more revenue? or maybe make your business more profitable? Are there less expensive ways that you can fill that need? Those are all going to be factors in whether or not something is reasonable. And that is completely different for every single business. So while it's reasonable for me to spend thousands of dollars on tax software, I bet it's not reasonable for you to spend that much. While it's probably reasonable for you to buy a commercial printer, it's really not for me, that sort of thing. So you'll want to think about that as you're walking into considering an expense. Ordinary is it normal for someone in your industry to incur this expense? And will the IRS agree with you? When you are reporting your expenses on your taxes, the IRS is using benchmarks of others in your industry to determine whether or not something is ordinary. So if you are incurring an expense that is completely unusual for your industry, I'm not going to say that it's definitely an audit flag, but you may end up with a love letter from the IRS saying, hey, this was really out of the norm. Can you explain why that was an ordinary expense to your business? And again, if you can take a position that you can justify, then that's fine. But you really need to think about whether or not you're comfortable defending that position. An example that I like to use is I had one performing artist client that he deducted a private helicopter to take him to stage for a concert that was out in the desert. And for most businesses, that would not be considered reasonable or ordinary. However, we were able to take the position that because of the number of people that were in the audience, because of the distance from his hotel, a few different factors, we were able to make the case that it was reasonable and ordinary for him to need to do that. And they agreed with us. So it really, really depends. Necessary is an easy one. Do you need it? No, then it's not deductible. If you need it to be able to do your work, then it probably passes the necessary test. But you may also want to ask yourself the question, can you do your work without it? Because there's a fine line between need and want when it comes to necessary. I want many things, don't necessarily need them. And then a really good question to ask yourself as you're considering these things is, would you buy it anyway? So I had one performing artist ask me why I wasn't letting her write off all of her makeup. Her prior accountant always had. And I said, well, you're a yoga teacher. Just kidding. So I asked her if she would buy the lipstick anyway, is essentially what it boiled down to. And so I let her take a few items of makeup that were specifically for stage, because we all know that the makeup that you wear on stage is not your everyday makeup. Similarly with stage clothes, props, those sort of things that you would not use in your everyday life, those are likely deductible to you. But if you would buy it anyway, even if you didn't have your business, then it may not be deductible, or at the very least, fully deductible to your business. Sometimes things can be partially deductible, such as your cell phone, your home office, but not 100% deductible. And that is something to definitely dig into with your accounting professional. How do we track these things? A lot of people ask me, is there a right way and a wrong way to track income and expenses? The wrong way is to not track them at all. Otherwise, there's not really a right way. It really boils down to whatever works for you and your accountant. So I play in the sandbox of QuickBooks Online all day long, but I also have many clients who send me spreadsheets. They sometimes give me handwritten ledgers. I once got a bunch of very smeared papers with soft pastel on them. That didn't work great. Please don't do that. But if it works for your accountant and it works for you, then chances are it's fine. There's no need to overcomplicate things unless there's a reason for it. So you might want to use a software if there's sales tax involved, or if you're needing to calculate distributions for investors or things like that. But really the easiest way you can meet the goal is the best one. However, some good best practices that I would encourage everyone to do is keep your receipts. I like to tell my clients that I don't need to see the receipts, but if you ever get a love letter from the IRS and they want to see them, please be able to produce them. Honestly, a shoebox full of receipts that goes with the spreadsheet that you created is perfectly fine, because as long as you know where to find that shoebox, if we need to talk to the IRS about it, that works. Spreadsheets, QuickBooks, all those sort of things. I want to caution you towards those because a lot of times they are easy to use, which means they are easy to mess up. So you can end up allocating things as expenses that were actually income, or there's this really cool thing in QuickBooks Online called reconciliation discrepancies that QuickBooks lets you just chuck stuff into. That's not a thing. Please don't use that. And then the other thing I wanted to mention is if you are keeping a spreadsheet like a Google Doc or a traditional spreadsheet, whatever it is, please send that to your accountant in spreadsheet format. I love a good spreadsheet. A spreadsheet that you have formatted to PDF before you send it to me is like really a bummer. And then keep separate bank accounts. This is a really big one. We want to make sure that all of your business income and expenses is happening within a business bank account, and that nothing personal is coming in or out of that bank account. So if you have business funds that you need to pay something personal with, make sure to transfer it to your personal account before you pay that, because the IRS loves to disallow expenses from businesses with just a blanket. You can't have these if they see personal expenses flowing through that business account. So don't pay your mortgage out of your business account, but do buy your canvases through your business account, that sort of thing. And the last thing I wanted to touch on here is that it's okay to be disorganized. I don't mind that at all. I love working with artists, and artists should focus on their art, not their spreadsheets. However, that is with the disclaimer that the more organized you are, the less time it takes people like me to complete our work. And therefore, sometimes people end up being kind of penny rich and dollar poor when it comes to paying for bookkeeping services, because it takes me 5 times as long to do the tax return at the end of the year if the books aren't fantastic, if that makes sense. So just something to keep in mind along those lines. Grants. Grants are cool. They're free money, but you got to be really careful what you do with it. As I was just talking about, most grants don't let you pay for personal expenses with that money. So you want to make sure that your grant goes into your business account and that you're paying for the things that the grant was intended to pay for, because a grant that is not considered taxable can become taxable if the expenses that you use it for aren't in alignment with what it was intended to pay for. Most of the time, there are terms within the grant documents that specify what you are and are not allowed to use those funds for. The other thing is that ask. A lot of times there's someone at the office that it's administering the grant that can answer questions for you as to what you are and are not allowed to spend that money on. Sometimes you're allowed to pay your employees with it, but you're not allowed to pay yourself, or check with an accountant to see if they have any feedback for you on that. Really, the most important thing is make sure that you understand those things before you go spend the money, so that you don't accidentally disallow a bunch of the awesome opportunities that come with the grant because you spent the money the wrong way or you treated it the wrong way. When in doubt, talk to an expert. People like me, I know there's a ton of awesome attorneys and financial advisors and more accountants through CBCA and the various other sponsors today who are happy to talk to you about this kind of stuff. I want you to understand it to the fullest extent that you want to understand it. But if you don't want to understand it and you just want to ask me, hey, can I do this? That's fine too. There's a reason that I'm in this industry, and it's not the glamour. Let's put it that way. Please don't DIY representation. If you get any love letters from City of Denver, Colorado, IRS, anything like that, asking you any questions about what you have filed, whether that be through an accounting professional or on your own, talk to a professional before you try to represent yourself in that matter, because it's so much easier for us to form a strategy from the get-go as to how to respond to these things, as opposed to trying to pick up the pieces after you have already tried to fix it yourself. So don't do that. Like I've already said several times, keep business and personal separate. I can't say it enough. It's probably the most important thing. Make sure that all of those things are kept separate. And don't be afraid to ask questions along the way. I don't believe in stupid questions. There's no such thing. You're just asking something that you don't know and someone else might. So, reach out to your network. That's most of what I have for today. So thank you to everyone for coming. Thanks to everyone for inviting me. I did put together a little free gift for anyone on this webinar. That is a free 15-minute consultation with me. The Calendly link will be in the chat or an email or somewhere else available to you, or you can find me on my website, csaaccounting.com. And then we're gonna dive into Q&A.
Yeah, thank you, Kaleigh. That was awesome. I did put the Calendly link. We'll share that a few more times for folks.
Great.
But we did get a few questions in the chat, and then I also jotted down a few other questions that I have heard outside of this presentation.
Perfect.
That we might want to touch on. The first came up towards the beginning when talking about self-employment tax. Does self-employment tax apply more to single individuals, or is this something we should be doing for our business? Which to me leads to a conversation about the difference between you and your business entity.
Great.
So if you're able to address that.
Yeah, great question. So in almost all circumstances, your business will be treated as its own entity, but the tax burden flows through to you as an owner. So if you're in a partnership, you own a certain percentage of that business, and the tax burden that is generated from that business is going to be calculated on your personal return based on the percentage that you own. If you are a sole proprietor, then 100% of the tax burden is going to flow through your personal taxes, and you're going to report everything there. So when it comes to estimated payments, you are estimating the amount that you personally will owe to the IRS. And while your business income is a factor in that estimate, you should always pay your estimated payments directly from your individual funds and make sure that they are allocating it to your individual account. And that brings up another great thing that I forgot to mention. Please make all estimated payments and payments to the IRS or Colorado or whoever electronically. I cannot tell you how much time I have spent on the phone tracking down checks that the IRS cashed but did not properly allocate to my clients' accounts. It's a nightmare, and it can all be avoided if you just set up an irs.gov account and pay there.
I was going to say, how do people do that? So irs.gov.
Yep, irs.gov. You'll just need to pick which tax year you are making a payment towards. And that should work from there. If you're married filing jointly, make sure to put it under the account of whoever the primary taxpayer, the first person listed on the tax return, is.
Nice. And you mentioned sole proprietors, you mentioned partnerships, you mentioned S Corp. Does that all go the same for an LLC as well?
Yeah, yes, exactly. LLC is usually either a sole proprietor if it's a single member LLC, or a partnership if there are multiple owners. So for tax purposes, it would be treated the same.
Awesome, thank you. Great question that we got about deducting expenses, and I'm sure this applies to many artists. If you do very different types of work as a self-employed creative and freelancer,
yeah,
which most artists do more than one thing,
yeah.
Can you deduct all of the stuff from your various types of creative work? Is there anything special you need to note? How do you handle, being a multidisciplinary creative?
Fantastic question. So if your art is similar enough in nature that a lot of the expenses kind of bleed over one another, then you can roll it all into the same. Typically, Schedule C is where you would report the income and expenses for that. You can put that all together. So if you work in different mediums, or sometimes you do graphic design, sometimes you actually print things, those sort of things, you can roll that all together. However, if you have other self-employment, like if you're a dog walker, you would want to make sure to put that separate from your art, because what is reasonable, ordinary, and necessary of an expense for a dog walker is going to be completely different than a sculptor. Or if you teach music, but you're also a sculptor, you probably want to separate those things, because what is reasonable for a music teacher as an expense isn't necessarily the same for a sculptor.
Excellent.
Clear as mud, right?
Yeah. And feel free to put more questions in the chat. I'm going through the ones I saw earlier, but we have time to answer several. There was another one in here. Do you have good examples for income expense spreadsheet templates that match up with what the IRS is asking for? Sort of what resources and templates are out there?
I have a few that I have made, and Meredith, if it works, I can email those to you so that you can distribute them. I've got a few that are for either musicians or, physical medium artists, but really there isn't a prescribed, you could go look at the tax forms if you're an insomniac or something, but there's not a cookie cutter answer on that.
Great, thank you. And yeah, happy to share any other resources, Kaleigh, that you want to send. One thing we didn't talk about,
sales tax.
People are sharing other things. We didn't talk about sales tax. And I also wanted to ask you about 1099s. How do you know if you should be getting one, and how should you know if you should be providing those? And what is it?
Question.
And if no one knows what a 1099 is, we can explain that as well.
Sure. So a 1099 is typically used instead of a W-2 to report earnings that you have used, or earnings that you've made as like an independent contractor or something along those lines. A common misconception is that if you don't receive a 1099, then you don't have to report the income. And that's just not true. You should report every dollar that you receive related to your business. You are not required to send a 1099 in most instances, unless the amount that you have paid someone is $600 for the entire calendar year or more. So sometimes you might think, maybe I should be getting a 1099, but if you earned $450 from that person, they aren't required to send one to you, but you should still report that income. Be really careful though, because the purpose of a 1099 is not to help you keep track of your income. It's so that the IRS knows about your income, because a copy is sent to you and a copy is sent to the IRS and a copy is sent to Colorado. And so if you don't catch all of that income on your tax return, then you're going to get those love letters that I talked about saying, hey, what about this 1099?
That's great. Someone also asked a question in the chat, sort of going back to our conversation about business entities. At what point do you recommend someone should form an LLC or form a formal entity for their work?
Sure. Back to the disclaimer of I am not an attorney. From an accounting perspective, it doesn't really matter with an LLC because it's all rolled into your personal tax return. There are many legal reasons why you may want to form an LLC sooner than later. And there are a lot of awesome attorneys out there who can tell you about that.
Yep. Many of them are part of Colorado Attorneys for the Arts. One of
exactly. But from a tax perspective and accounting perspective, it doesn't matter.
That's great. And I think you were going to talk to us a little bit more about sales tax.
Yes, sales tax. Sales tax is so complicated, especially if you are in Colorado, because we are what's called a home rule state, which means that every single jurisdiction, usually cities or counties, get to make up their own rules about sales tax. But generally speaking, if you are selling a product, then it should probably be subject to sales tax. Sales tax is paid by your customer. It is a percentage that you tack on to the transaction, and then you file and remit it, usually quarterly, sometimes monthly, depending on your volume, to the various jurisdictions. Unfortunately, the percentages are always different, and it's based on where your customer takes possession of the thing. So if you sell online, sales tax is kind of the Wild West, because you have to charge sales tax based on where your customer receives the product, which is likely their home. There are some resources out there. TaxJar is pretty cool, that will help you to calculate what the sales tax burden is. But if you have significant sales that are happening online or in any particular city, you probably have a sales tax obligation, at least to the state, if not to the city and county as well. And a checkup on that is always worth doing with an accountant. We have some pretty cool tools that we can use to figure out where you have a filing obligation and how often and to what rate. So definitely check with your accountant on that one. It's complex.
Yeah, thank you. Another thing that I've seen people have confusion over, and you mentioned it briefly when talking about deductions, is people's home office or home studio.
Yes.
What advice do you have about is that deductible or not, or like in cars and mileage? You talked a lot about sort of physical things that can be deductible.
Sure.
Some of those other bigger items or intangibles.
Great question. So it depends a lot on your entity type, because if you are a corporation and you issue W-2s to your employees and your owners, then you may not be able to deduct a home office. Whereas if you're a sole proprietor, LLC, you may be eligible to deduct some square footage of your home that is dedicated home office. And that is the hurdle that most people don't get past, is it has to be used exclusively for business. And you cannot use that space for anything else. So I've heard of a case where the IRS disallowed a home office because the owner had some personal scuba gear in the closet. And therefore they said that the square footage of that room was not exclusively used for business because there were some personal items in there. One would argue that these Legos that I have behind me could be something that would disallow my home office expense. So you'll want to be really, really careful with that. But if you have a room in your house that you have converted to teach piano lessons or something along those lines, and you really don't use that room for anything else, then you could be eligible for home office deduction, which is either calculated using just the square footage and a flat $5 per square foot of that home office, or you can take the overall square footage of your home, figure out a percentage that that home office represents, and then sometimes you can deduct other home expenses such as your utilities and your internet and things like that. So it's a little bit complicated, and there's a lot of if this, then that sort of logic that goes into it. But in general, home office is one of them that I see disallowed more frequently in examination than I see it allowed. Mileage is great. I recommend the app Mile IQ because it uses the GPS on your phone to track every trip that you drive, and you can simply classify it as business or personal, and then it tells your accountant exactly how much you are eligible for as deductible mileage. And then, frequently people use their personal computers or personal cell phones. You'll want to figure out whatever percentage you think is reasonable for those things that you do use it for business. And then your accountant might be comfortable taking 20% of your cell phone bill as business. But another important factor there is that if you have a lot of other income, so if your art only represents maybe 10% of your total income picture, then we very likely can't take more than 10% of your cell phone, which is a really common misconception as well, it's 90% for business.
Yeah. Great. That's super helpful. And it's interesting, all those, it's never quite a bright yes or no line at
Yeah.
the beginning. I'm going to pause here. Those were all the questions that I saw.
Great.
From folks. If anyone has anything else, this is a great time to ask any final questions. I will put back in the chat that very generous offer for a 15-minute consultation with Kaleigh. If you want to use that Calendly, I will never be able to say that word, Calendly link. That's great. And then I will mention, see if there's any other questions. Don't see any more coming in. What's next? We will get this recording posted and shared. We will send a follow-up email to everyone who registered for today's workshop, and we appreciate so many folks logging on and joining us live. We have our next few tools for the creative life webinars coming up. Oh, I do see one more question in here. TJ asks, how do you pay city tax? I'm guessing, is that city sales tax? Or
there's a couple different types of city tax. Denver is really awesome in that Denver has what we call a head tax. It's occupational privilege tax, where you pay for the privilege of working in Denver. It's usually like 10, 12 bucks a month for every business owner. And you can set up the license to remit that to them and file all of that online. Almost every city now has an online portal for helping you to calculate and file those things along the way. But if it gets confusing, someone like myself, an enrolled agent, that makes me kind of a tax specialist. And many people on my team are happy to help you at least stand up those licenses and show you how to file those things so that you're compliant on that. And I think that would probably be the city tax that was being referred to. We don't have as many like city income taxes in Colorado as other places like Chicago or Detroit.
Yeah. Oh, good to know. I love the occupational privilege tax.
It's a privilege to occupy Denver.
Great. Well, some of the other upcoming workshops and webinars we have, I don't think these are publicly announced yet, but I think I'm okay to mention them. We have one coming up on November 21st at Converge Denver. We'll be working with Thomas Evans, otherwise known as Detour, who is a very famous local, I think he's famous, local artist, muralist. He even wrote a book about being an artist and having a successful art business. So that's coming up in November. And then in December, we're bringing back for the second year our Bad Art Night. So we have a facilitator, we have lots of fun art supplies, and it'll be hosted at a brewery, and we'll just have an evening of making really bad art together and sharing it as a fun way to end the year. So please be sure to stay connected with us and all of our programming partners on behalf of CBCA, the RiNo Art District, Denver Public Library, Transforming Creatives, and Converge Denver, and the Creative Integration Initiative. Thank you so much for joining us today. Thank you, Kaleigh, for answering questions and sharing such great information. We appreciate it. Wish you all a great rest of your day. Thank you.